folks, welcome on back. Next topic. What is fair value? How is that different from fair market value, or what some people call intrinsic or rational value or relative value? Well, the good news is for US GAAP, it's all laid out for you. So we're going to lay out the important terms with respect to the terminology and how you come up with fair value if there's not a market, an actively traded market for that security, right? It's easy with stocks and bonds. If they're publicly traded, well, the fair value is the market value because there's a market for it. But some things that are on your balance sheet, asset or liability, are not regularly traded on an exchange. So if you're supposed to mark that to market value, how do you do that if there is no market? Well, good question. That's what we're going to figure out now. So US GAAP, good news, is standardized the definition of fair value, and they give you a framework for measuring fair value just in case there's not an exchange where that asset or liability is being regularly traded, okay? Now, there's certain disclosures that have to be made in the footnotes. So the fair value disclosures are for all areas we're going to go through that either require or permit you to mark that asset or liability to market value at year end. But these rules do not apply because special rules apply to share-based compensation. We use the Black-Scholes-Merton option pricing model, some exciting stuff, or if it's a lease, okay? Special rules apply there or vendor specific, but the share-based compensation, the leases have their own separate rules. Okay, what is fair value? First of all, it's an exit price, not an entrance price, exit price. So when you see fair value, you think exit, or I want to take my money and go. Fair value, an exit price. So it's what we would receive if we were to sell the asset or transfer the liability, but in an orderly fashion, not a fire sale. Nobody has a gun to your head. You're not bankrupt and looking to give it away or whatever. Okay, so it's an orderly transaction between market participants. And normally, if there's an exchange, well, it's very simple. All right, the orderly transaction will be on an exchange, very simple. All right, now if there's not an exchange, okay, or a principal market like an exchange, then we got to figure out, well, then how do we do this? Then we're going to look for what's called the most advantageous market. So there will either be a principal market where it's formally traded all day, every day, okay, bought and sold and exchanged. That could be the principal market. Or if that doesn't exist, you know, your particular piece of real estate, your piece of equipment that you want to sell, well, that doesn't actively trade on an exchange, right? So we'd have to find what's called the most advantageous market when a principal market does not exist. Okay, it's not what the entity says it is, it's what the quote-unquote marketplace says it is, okay? Principal market, if there's like an exchange, right, where it's traded all day, every day, just think about the New York Stock Exchange, things of that nature. If there is no principal market, then fair value is measured on what's called the most advantageous market, but only use that when there's no principal market. Okay, more to come on that in a second. We already know fair value. I'm going to take my money and run. I'm exiting the door with my money. It's an exit price, we know, not an entrance price, okay? And that market price has got to reflect all the assumptions that the market participants would use in pricing that asset or liability. So like in the stock market, stocks that trade on an exchange, you know what? People are making certain assumptions, like what do they think the dividends or the earnings are going to be, whatever. And then they, you know, figure out what they'll pay for it, what they'll sell it for, okay? So that's automatically built in the stock market. Very important right now. Make sure you remember this. You ready? Fair market value does not include transaction costs. You got to remember that. But it does include transportation costs if location is an attribute of the asset or liability and it's got to be shipped. So you've got to remember for me, that definition of fair value does not include transaction costs, but it might include transportation if location is relevant, okay? Now, note something about transaction costs, very important. While transaction costs are not going to factor into determining the fair value, it might be necessary and relevant to figure out what the most advantageous market is if there's no principal market, there's no exchange. So transaction costs do not determine fair value, but they might be used to determine the most advantageous market in the event there's no principal market. And we'll see more of that in a second. Now, look, sometimes we're finding the fair value not of stocks and bonds, but a non-financial asset like land. And when we figure the fair value of a non-financial asset like land, I don't care how you're using it. The fair value is dictated by the highest and best use of that asset. So when it's a non-financial asset, particularly land, you might put a house there. Others might put an apartment building there. Somebody else might put a retail store. I don't know. But a non-financial asset, when we determine fair value, you must remember, it's determined by the highest and best use. More to come on that in a second. Now, when it's a liability, when you factor in the fair value of a liability, you should most definitely consider non-performance risk, default risk, that the borrower, the debtor, may not pay it. So you've got to factor in the risk of default. Now, some securities, if they're backed by the full faith and credit of the U.S. government, virtually risk-free, not an issue. But most other borrowers, there could be some default risk, and that's heavily dependent upon credit rating. But yes, for a liability, we've got to consider default risk, non-performance risk when figuring the value of that asset. And in the real world, that affects the discount rate that you apply to the future coupons and the principal. The higher the risk, the higher the discount rate, that will reduce the fair market value of that liability. Okay, when you're looking at the fair value of your own equity, we don't care about the book value of your equity. We know the assets and liabilities could be measured in a variety of ways, most of which are not at fair market value. So folks, what's relevant for the fair value of your equity is what it's trading for on an exchange, not your own book value. Oftentimes, we know there's a big difference between the fair market value of the stock price versus the book value of the equity. Okay, remember, when we determine fair value, we need to know, is this an orderly transaction? Okay, the asset or liabilities in the marketplace for a period before the quote-unquote measurement date, giving market participants enough, time, the usual and customary time to transact, to buy it or sell it. It is not a fire sale. It is not fair value if it's a quote-unquote forced transaction. The fire sale might be because you're going bankrupt. Hey, everything is discounted, or maybe a foreclosure on your house and now the bank is foreclosed and now they're selling it at an auction. That's a forced sale. Okay, that's not going to determine fair value. Lots of times properties are bought at a steep discount if it's at an auction or bankruptcy, whatever, okay, or it's been seized by the government, whatever. All right, we're talking about a normal, ordinary transaction, usual and customary circumstances. Okay, first of all, the market participants have to be unrelated, independent of one another. You might give somebody a discount because they're related to you, or if you're in my family, you charge me a premium. Buyers and sellers who are independent of one another, not related parties. And they're people who are knowledgeable and they're willing and able to transact. Okay, willing to do it, but they also have to be able to do it. They got the money to actually buy it. Okay, willing and able. Now, you've got to be acting in your own economic best interest. You're only going to do that if the parties are unrelated. You're not related parties. The transaction is not between a parent and a subsidiary or between two subsidiaries of the same parent company. So no discounts. And lots of times there's inflated prices. Why would you sell something to another subsidiary within the same conglomerate at an inflated price? Well, that's transfer pricing. You're trying to manipulate, companies that are located in high tax jurisdictions. You want to charge them a higher price. So they reduce their taxable income, so they'll pay less tax, etc. Okay? None of that. It's got to be unrelated parties. Everybody's acting in their own interests, okay? Not between parent subsidiary or between brother and sister companies or any of that stuff. Okay, what is a principal market? It is the place with the greatest volume or level of activity for that asset or liability, the greatest volume. So you might have a security that's traded on multiple exchanges around the world. Which of those exchanges will be the quote-unquote principal market? The one with the greatest volume. So when we have a security that trades in multiple markets around the world, the principal market will be the one with the greatest volume, okay? Now, for this principal market to apply, well, that reporting entity has to have access to it or forget it, okay? So we look for the greatest volume, but just make sure, devil's in the details, that reporting entity actually has access to that market, can list it for sale there or buy it, whatever. Okay, if there's no principal market, then what do we have to determine? Well, what is the quote-unquote most advantageous market? I must be building your confidence. You're like, how did this dumbass pass? I can't pronounce advantageous. It's too big for me. Shorten that word. The best market. Why didn't they just call it the damn best market? So the most advantageous, I still can't say it, the most advantageous market. So that's the market with the best price, but be careful. All right, you ready? If it's an asset, it'll maximize the selling price, or if it's a liability, it'll minimize the payment to transfer the liability, all right? So with an asset, you want to maximize the selling price, but with liability. If it's an asset, you want to maximize your selling price, right? Receive the most. But if it's a liability, you want to settle the transaction for the least amount. minimize the payment. So be careful, okay? So the most advantageous, best price, asset maximize, liability minimize after considering transaction costs. All right, now be careful. We saw this a few minutes ago. Transaction costs are relevant when determining the most advantageous market. But once you then determine the most advantageous market, highest selling price if you own it, or minimize the payment to transfer a liability, when you actually consider the fair value, then you ignore the transaction cost. So we're going to see this in an example, but the most advantageous market, step number one, maximizes the net realizable value if it's an asset. If it's an asset, you want to maximize the selling price, minimize the transaction cost so you got the highest net realizable value for an asset. Or if it were a liability, you'd want the lowest net realizable value for the liability. But now look, once you've determined which market has the highest net realizable value for the asset, then you go back to the selling price to give you the fair value. You only use the transaction cost to determine the most advantageous market. So look at this example. Excellent. Garrity holds stock in Foxy Company. Now, he has access, not an issue, to both New York and London markets. So look, which market here is going to be the principal market? It trades on exchanges around the world in both New York and London. Well, tell me the one with the most volume, okay? So whichever market, whether it's New York Exchange or the London Stock Exchange, whichever one has the most volume, that would be the principal market, period. You're done. They'd have to give you information about volume. Now, what if, though, there is no principal market and we've got to determine the most advantageous market? Step number one, this is an asset. He holds stock. This is an asset for Tim. Find me the market with the highest net realizable value. So even though the New York market has a higher quoted stock price, forget that. What's the net realizable value? Well, the transaction cost, of course, it's New York, it's 6 versus London, only 2. So step number one, to determine the most advantageous market, tell me which market gives you the highest net realizable value for that asset. Well, it's London. Now, with that being said, though, once you've determined that London is the most advantageous market, don't use 48 as the fair value. That will be the most common mistake. Instead, use the actual stock price, 50. All righty, so we only use the transaction cost to determine what is the most advantageous market. Once you've done that, then go back to the price. And the price here, London would be 50. Don't use the 48. That will be the most common wrong answer choice, okay? The transaction cost is ignored once we've determined the best market. Forget most advantageous. All righty. Now, sometimes we're dealing with land, all right, non-financial assets like land. So then fair value is measured taking into account, well, how would this land generate the best, the largest economic benefits? That's called highest and best use. So for a non-financial asset, we've got to determine how could you use it to generate the most money, the largest economic benefit. Okay, now we assume whoever owns the asset, whoever's currently using it, is probably using it at its highest and best use. But if they're not, okay, if they sell it to another market participant, then we got to assume they would use it at the highest and best use. So using it or selling it, we're looking for the highest and best use. Now look, whoever is using it currently at its highest and best use, they give you a number. And then if they sell it to another market participant, they could use it as well at its highest and best use, but get a higher value for it. The fair value would then be the higher of the two. So if somebody's currently using it at its highest and best use, then you're going to sell it to somebody who would also use it at its highest and best use. The fair value then would be the higher of the two. Just be mindful. The entity that currently owns that asset is presumed to be using it at its highest and best use, but they might tell you that, hey, for whatever reason, they're not. All righty? So there might be other facts in there that say, you know what, though, somebody else would use it in this way. Instead of putting a single-family home, no, they'd put an apartment building there, which would generate a lot more income. Well, then that would be the highest and best use, okay? But fair value, absent anything else, would be the higher of the two. Okay, now when you look at highest and best use, sometimes the asset, you've got to consider it in combination with other assets and liabilities. We'll see an example in a second. But when you look at the land, you might say, well, there's a building on the land. We got to take that into account. Or maybe there's debt. We got to take that into account as well. We'll see that in an example in just a second. Okay, highest and best use, folks, does not apply to stocks and bonds, financial assets. It's just not relevant. So anytime you see highest and best use, in relation to a financial asset, it's immediately a wrong answer choice. Got nothing to do with financial assets. Financial assets, it's all about a principal market. If there is one, the principal market is one with the highest volume, or if there's no principal market, most advantageous market. Alrighty. Now, take a look at this excellent example. As part of a business combination, a reporting entity acquires land that is currently the site of a factory. Okay, so the current owner is using it as a factory. That's their use. All right, now land is a non-financial asset. All righty, the fair value is going to be the higher of your use, which we'll presume is the highest and best, or how another would use it, okay, assuming they would use it at its highest and best use as well. All righty. So they tell us similar sites in the area were recently developed for other purposes. So rather than using that land for a factory, you could use it for residential retail space. All right. So that might be a way to generate more economic benefit, higher value. All righty. So the value as land as currently developed, you must consider the value of other assets, the value of the land plus the value of other assets and liabilities related to the land. Like there's a building on it. Okay. Maybe there's a liability on it. You got to consider that as well. Okay, the value of the land, then you can consider, well, what if we developed it otherwise and we used it for residential and retail space? Well, the value of the land as a vacant site for residential or retail use, well, then you'd have to consider the cost of tearing down that factory. You've got to consider that. That's got to be considered. Also, you got to consider any uncertainty. You know, if you put residential and retail, you know, what's the probability you rent it? Etc. All of those are relevant factors, right? Common sense when determining the fair value of this land. Now, fair value will ultimately be determined how? Whichever use, either as the factory with the building and the debt, or potentially developing it, putting residential, retail space, and then you got to consider the uncertainties, whichever results in the what? Highest use. All righty, and there you go. That's non-financial. Beautiful. All right. Let's do another one. Come on, you're not tired. Let's do another one. See you back in a minute. All righty, welcome back, everybody. You ready? Let's talk a little bit more about fair value measurement, the framework. All right, then some disclosures and exceptions. First of all, again, we know U.S. GAAP has established that framework for measuring fair value. Step number one, what are the different techniques you can use to measure fair value? And then step number two, the inputs that you use. There's a hierarchy of inputs. There are certain inputs that are more reliable than others. So there's different valuation techniques and then different inputs you can use. And they'll rank the inputs, level 1 from most reliable to level 3, the least reliable. Okay, I need you to memorize for me. Mike, I want to value. What are my valuation techniques, Mike? So MIC, yeah, you know me, MICKEY, you don't even know what I'm talking about. So Mike, what are those valuation techniques? Well, the three are the market approach, the income approach, the cost approach. Those are our valuation techniques. The one you choose has got to be appropriate under the circumstances. Like you're not going to use an income approach if the asset doesn't produce income, okay? Now, it should maximize the use of observable inputs, level 1 and 2. So when we come up with value, we want to try to maximize the observable inputs, things that are most reliable. So use level 1 and 2 inputs as most possible, and minimize the use of things that are least reliable, the unobservable, the estimates, what we'll call level 3 inputs, all right? So whatever technique you use, when coming up with value, maximize the use of what's observable, levels 1 and 2. Try to minimize the use, only use it if necessary by default, the unobservable level 3 inputs, okay? Now, can you change a valuation technique? Yeah, if it's appropriate under the circumstances, you might change a valuation technique, go from the M to the C to the I, whatever it is, but it's got to be justified. It's got to make your financial statements more reliable and present them more fairly and stuff like that. And if you do change valuation techniques, folks, that's a change in estimate. We don't restate anything. We just use the new technique now and going forward. Okay, so the valuation techniques. Mike, I want to value these assets. You ready? What's the first technique? The market approach, 1 of 3. We love it. When it's actually traded on an exchange, there are market transactions for this identical asset. okay, for this identical, or if it's not exactly the same, very comparable asset or liability. But we love it when there's a market. And that market is made up of who? Lots of buyers, lots of sellers, independent of one another, all trying to maximize their own personal gain. Okay, everyone's acting in their own best interest. We love it when there's a market. All right, that's the first valuation technique. The second one, you ready? The I in Mike, the income approach. But the asset's got to produce income for you to use the income approach. This is discounted cash flow. The value of any asset is really the sum of the present value of the future cash flows. So you'd have to estimate the future cash flows, discount them back to today. Now, the same asset might be, or the same security might be an asset to one side. You buy the bond, it's an investment, you're going to receive the coupon payments and the principal. That same debt security, though, might be somebody else's liability because they're making the payments for the coupons and the principal, okay? But that's the income approach. Discounted cash flow, the sum of the present value of the future cash flows. Okay, the third valuation technique is a cost approach. Hey, just tell me the replacement cost of that item, all right? And that will be the valuation, the replacement cost, okay? Now, the hierarchy of inputs. We want to prioritize the inputs, common sense, from most reliable to least reliable. Well, level one's going to have the highest priority because those things are considered most reliable. Level three is on the other end of the spectrum because those are considered the least reliable. That'll have the lowest priority. All right, so any valuation technique, Mike, I want to value those assets. Maximizes the use of what? Observable inputs, which are levels 1 and 2, but only use if you have to. Minimize the use of unobservable inputs, level 3. Okay, your level 1 inputs, well, these are things that are observable. Anything that's on an active market and that's identical, that's the best. It's an observable, it's active market, it's identical. So IBM stock trading, period. Okay, all the stock trading on that market, well, it's identical. Every share of stock, assuming same class, all that stuff, and it's identical and it's an active market. All right, so anytime you can get it from an exchange, New York Stock Exchange, or dealer markets, or broken markets, or principal to principal, but there's a market for it, it's active and identical, that's considered the most reliable because it's independent and objective. Everybody's acting in their own best interest. The market has a lot of buyers, a lot of sellers. It's not a forced sale, not related parties. It's independent and objective. Your level 2 inputs are observable, but it may not be exactly the same asset, but it's similar. It's comparable. It's an active market and it's comparable, or it's identical, but the market is not very active, not a lot of volume. Okay, so level 2 inputs are observable. It's either a similar, comparable asset on an active market, so it has the same credit rating, same industry, same size, okay, but it's not this company's debt, it's somebody else's company. But you know what? They're exact same size, exact same risk, same credit rating, okay, similar asset, and this is trading on an active market. Or it's the identical asset or comparable if there is no identical asset, but the market is not active, okay? It doesn't have enough volume to be considered active. Level 2 inputs are observable and they're quoted. It's either a quoted price or they'll use the word observable. All right, that's how you know it's a level 2 input. All right, it's observable, it's quoted. Okay, level 3 is last resort. When you see level 3, what do you think? Least reliable. Minimize the use of this. Why? Because it's unobservable. It's based upon the entity's assumptions. All right, so you're trying to value somebody's stock that's not traded on a market. Okay, it is not traded. This company is privately held and not traded on a market. And truth be told, there's no comparable asset because this company's so small, it's a startup. So how are we going to come up with value? Well, we're going to have to come up with the income approach, the present value, the future cash flow. But we're going to have to rely upon management, the entity's assumptions to try to forecast future cash flow. So it's biased. It's the least reliable, but there's nothing else we could do. All right, so it would be the present value, the future cash flow. They'd have to help us forecast the future cash flow. If they're not publicly traded, right, we don't have ready access to their financials, right? There's no 10K that we could go to a quarterly report. So we need management. So it's biased. That's why it's the least reliable and it's unobservable. Okay, so we're going to have to estimate future cash flows. This is not factual. It's an estimate. And then we got to estimate the discount rate to apply to those future cash flows. It's only used when there's no other choice. There's no observable level 1 or level 2 inputs. Both level 1 and level 2 are observable. There's neither of those. Or rare, but there's undue cost and effort required to get the observable inputs, okay? That would be a crazy question if they threw that in there. We'd be pretty pissed. All right, fair value disclosures in the footnotes. I need to understand your methods, your assumptions. So the valuation technique you use, I need to know about it. Okay, so which of the MIC did you use? The market, the income, or the cost? So the valuation technique you used, and then the inputs. Is it level 1? Is it level 2? Okay, and then I need to know if it's level 3, unobservable, well, what judgments and assumptions did you make? Because discounted cash flows, if you put in your numerator a future cash flow, and then you put in your denominator, if that's a one-time future cash flow, 1 plus your discount rate, well, that's how you get your present value. Well, what judgment did you use? Because chances are, if the future cash flow is overstated and or the discount rate is understated, that'll increase the fair value of that asset. Okay, so obviously companies are biased in that they want to maximize the value of their assets while they minimize, do the exact opposite if it's a liability. All right, so the entity's got to disclose certain information regarding the fair value measurement. All righty, so we know the MIC, the valuation technique, and then we need to know what inputs they used. And if it's level 3, we need quantitative information about relevant, significant, unobservable inputs, like the forecast of future cash flows in the example I just gave, like the discount rate. And then you also got to talk about sensitivity. What if you change the future cash flow? What if you change the discount rate? For example, let's say you increase the discount rate from 3% to 3.5. How sensitive is the present value to that change in the discount rate? How quickly will that present value come down? And or future cash flows. So if it's an asset, we know if you reduce the numerator, the future cash flow, that'll reduce the fair value, the present value of those future cash flows. The question is, if you reduce the future cash flows by a relatively small amount, 2%, does the present value come down by 2% or more than 2% or less than 2%? How sensitive are we to those inputs, okay? Take a look at a great example. They tell us during the year, Marker 8 Company purchased 3,000 shares of Millage Inc.'s common stock. At the time of the purchase, the stock was trading at $24 per share. So stop right there. Common stock, it's a financial asset, so highest and best use is not relevant. Our cost, well, $24 per share. So this is common equity. Assuming we have no significant influence, you're a small stockholder, we'd have to account for this. It's held for trading. Fair value through the P&L. You'd have to market to market value, year-end adjustment, and any gain or loss would go through the income statement. Unlike fair value through OCI, where any unrealized gain or loss goes direct to equity, not here. If it's common equity and you have no significant influence, it's counted for what we used to call held for trading or fair value now through P&L. Okay, the quoted stock price, well, this is great. This is on a public exchange. I love it. So we're going to use a market approach. That's the M in Mike, right? And this is active and identical. It's a level 1 input. So I love it. Public exchange, we're going to use the M and the MIC. That's the evaluation technique. Market approach. There's a market for this asset. It's publicly traded and it's active unless they tell you otherwise. The public exchange, it's active and it's the exact same stock. So that's a level 1 input. We love it. Year-end price is $21.50. Well, let's see. Is this good news or bad news? Bad news. 3,000 shares. You purchased at 24. It's only worth $21.50. So when you bought it, it cost you 72. At year end, when we do our adjusting entry, well, it went down in value to 64,500. 3,000 shares times only 21. That would be an unrealized loss on the income statement. So using the market approach, we'd have to reduce the value of the asset, and this unrealized loss would flow through the income statement. Net income would go down, thus retained earnings would go down, ultimately making your equity go down, but it would flow through the income statement. So you'd have to reduce the asset and then record, obviously, your loss, which eventually would be closed out to retained earnings and equity, making equity go down so your balance sheet is in balance, okay? So excellent example. You got to identify the asset. It's financial. What valuation technique? Oh, yeah, the M and Mike market approach. What's the input? Oh, yeah, level 1. It's active and identical. All good stuff. Now, exceptions to fair value measurement. Remember, if you haven't studied it yet, certain assets under U.S. GAAP, we use the cost method. While that might be less relevant, it's certainly more reliable. So certain assets under U.S. GAAP, see your PP&E, property, plant, equipment, that you're using in the business. It's not held for sale. okay, then we don't mark those assets in the United States to fair value. Now, my friends who are studying around the world, IFRS, you could either use the cost method like US GAAP, or you could mark it to market value. Under US GAAP, we don't, the assets for use in the business, the PP&E, we don't mark to market value, okay? Or the intangibles either for use in the business, okay? That's different than IFRS. So my international students make note of that. So again, situations where you're not going to use fair value, simply not practicable, okay? Cannot be reasonably determined or cannot be measured with sufficient reliability, all right? So if you can't use fair value because it's not reliable, then obviously you're going to have to use cost. Cost you can always verify, right, with an invoice. So it might be less relevant, but it's certainly, at least if you could look at an invoice, it's certainly more reliable, okay? Excellent, excellent, excellent. Stop here. I'll let you guys do some multiple choice. See you all back in a little bit. Good luck studying.